Most of our clients, and probably yours as well, have three main objectives. Number one, they want to minimize taxes, they want to maximize the amount that goes to their family, and most of them want to do something to benefit their community. Those three objectives become a challenge when it comes to selling a business during their lifetime and dealing with IRAs at their death. Let's discuss selling a business. Over 90% of the businesses in our country are closely held. Nearly 80% of those owners define themselves as charitable. Historically, they donate more in their time and their money. And 30 to 40% plan to sell or exit their business within the next 5 years. Roughly 70% want to include charitable giving as a part of their exit strategy. But two of the obstacles they face are, number one, very few of these businesses are owned by just one person. They may be owned by multiple individuals and sometimes family members. We have an article on our website that our CPA partner, Carolyn Smith, has written entitled Shared Ownership, Shared Risk. There's also a short video that she did that you may want to review. The next obstacle is that once negotiations start, and this is probably a bigger obstacle, everyone, the buyer and the seller, are focused on the transaction, and it's very difficult to get them to think about anything else. Now let's shift and talk about retirement plans, specifically IRAs. The IRS has determined that there is $8 trillion in traditional IRAs, and they don't like the idea that money is being wrapped up for a long period of time with extended payouts. For IRAs that are over $10 million, or even more changes coming down the pipe that have been included in a recent tax bill passed by the House. So what are the obstacles for IRAs? As I mentioned, the stretch is gone. With very few exceptions, you can no longer go beyond 10 years in the payout. Some common obstacles that these two issues face are, number one, lack of awareness of the tools and techniques that the individuals don't understand, and in many cases, neither do their advisors. The second one is that the income is subject to claims of creditors when it's coming off the sale of a business or the IRA. In addition, the management of these funds may not be as efficient as it was during the individual's lifetimes, the business owner or the IRA holder. One thing is almost certain is taxes are likely to rise. A possible solution is what we call a family legacy trust. If a business owner contributes part of their business interest to that trust and is subsequently sold, there are no capital gains taxes paid. For IRA owners, they can accomplish at their death stretch payments through this same tool. This solution meets all the objectives we've identified above. But because timing is always of the essence, we suggest our clients create a standby trust to hold their retirement plan assets or the proceeds from the sale of the business. A standby trust is created during their lifetime, it's on standby or it's in dormant mode, and will become operational only when specified triggering events occur. Most importantly, start planning today. But remember, these tools only have application if your objectives are to minimize taxes, maximize the amount to your family, and benefit the community. At C3 Financial Partners, we look forward to helping your clients gain clarity in their goals and objectives, confidence that they are making the right decisions, and coordinating with you and their other advisors.